Did you know US interest rates have been stuck at a 23-year high between 4.25% and 4.50% for over half a year? But just holding that rate has sparked more debate than you'd expect. What does that mean for your wallet? Interest rates are the backbone of personal finance, from loans and mortgages to savings and investments. When the Fed decides to pause or adjust rates, it affects how much consumers borrow, spend, and businesses invest, and shapes the broader economic landscape. The Fed is walking a tightrope. On one side, inflation is gradually cooling, edging closer to the 2% target. On the other, the economy is sending mixed signals. Consumer spending remains solid, but housing and retail data look weak. Economists warn of possible political pressure, especially with voices like Trump pushing for immediate cuts. Yet, central bank leaders like Atlanta Fed's Raphael Bostic say caution is key. He expects maybe one rate cut by late 2025, only after inflation falls closer to 3% and growth slows to around 1.1%. Meanwhile, Reuters polling shows two Fed governors may dissent this week, calling for cuts despite overall consensus to hold steady. Several factors are at play. Inflation, tariffs and supply shocks remain threats. Policymakers fear a renewed surge if cuts come too early. Economic data, while retail and hiring show resilience, housing starts and credit demand remain low. Manufacturing and business investments are slowing. Central bank messaging. Fed officials like Lisa Cook emphasize patience, highlighting uncertainty and inflation risk skew from tariffs. Political pressure. Trump has publicly criticized Fed Chair Powell and suggested rate cuts, yet Powell insists on data before action. Fed independence is under scrutiny with growing political commentary. The key insight: the Fed is prioritizing clarity over speed. Most policymakers favor holding rates right now, with potential cuts still months away. Market expectations align. Economists and futures market now widely expect rate cuts starting only in September or later, not July as some had hoped. A rare dissent from officials like Waller and Bowman may signal divergence ahead, but the consensus is still to wait until inflation eases and wage growth cools. The Fed is choosing restraint over haste, holding rates high as long as uncertainty lingers. Inflation must fall, the labor market needs softening, and tariffs must show impact before policy shifts. Markets remain cautious, and so should you. What's your take on this? Should the Fed act now or wait for clearer data? Share your thoughts in the comment below.